Well, it's now been about 80 days since the war in the Middle East began, and right now, things are still at a standstill in the Strait of Hormuz. Actually, last week, we got the latest reports for inflation. That's the CPI, the Consumer Price Index, and the Producer Price Index. Both surprised to the upside, meaning that inflation came in higher than expected. And so we are now starting to see the signs that this prolonged war is starting to have on price levels in the U.S. economy. We're really starting to see this show up in the bond market, though. That's what I want to touch on for a few minutes this week, because just to the extent that it could have some kind of an impact on risk sentiment and the overall equity market. We actually saw equities sell off on Friday because we saw bond yields spike. So if you look at the long end of the curve, the 30-year Treasury is now yielding about 5.1%. We've surpassed 4.5%, which most see as kind of this critical level on the 10-year Treasury. So as of this recording, we're at about 4.6%. And then finally, we are seeing the 2-year Treasury yielding about 4%, actually 4.1% to be exact. So why does this matter? If we look at the shorter end of the curve, so that 2-year Treasury, it's actually yielding about 25 basis points or 0.25% higher than the target Fed funds rate, so the policy rate that the Fed controls. That is essentially the bond market signaling that the Fed is possibly off sides here, and they should actually have policy be a little bit tighter. They should raise rates because inflation is starting to become a problem. So not surprisingly, we are starting to see that expectations for the next policy move are pointing towards a hike rather than a cut. So in short, with Kevin Warsh about to assume the role as Fed chair, he's actually being sworn in on Friday by President Trump. I do not envy his role. He's coming in at a really tough time. And so we'll see where policy goes from here. But that is what the bond market is saying. In the intermediate and the longer end of the curve, so the 10, the 30-year Treasury, we're seeing yields move a lot higher, as I said. Now, historically, there's a couple of reasons that yields can go higher. Some can be good reasons. We could see yields go higher because bond market investors are expecting the economy to really heat up, to grow quite a bit faster. This is not one of those cases. And this is one of those bad reasons where people are really looking at the fact that inflation is a problem and it risks becoming unanchored if we don't see resolution in the Middle East and or some move by the Fed to try to put downward pressure on inflation and keep it contained. So as far as what we're looking at this week, it's a relatively light week as far as the economic calendar goes. We'll be focused on earnings. So we're about 90% of the way through this earnings season, but we've saved the best for last. As usual, Nvidia is one of the last to report. So they'll be reporting this week. They are the most valuable company, so current market cap of about $5.4 trillion, and they account for almost 9% of the S&P 500. So really one of the biggest names out there in this artificial intelligence themes, and so they can really move the needle. But we're going to be focused not just on Nvidia, what they have to say about the state of artificial intelligence, but also on consumer. There's a number of big retailers that are reporting this week, and so we want to know how the consumer is doing. We're scheduled to hear from Walmart, Target, Lowe's, Home Depot, TJX, Ross stores, a number of retailers. And so what we're not really looking for how the consumer did in the first quarter, which is what they'll be announcing, but we're going to be looking for signs of a weakening consumer, whether any propensity to spend or just buying habits or intentions are changing among the consumer. We know that in the first quarter, households were generally supported by the One Big Beautiful Bill Act, which provided a higher tax refunds for households. The average household saw their tax refund increase by about 18% over the prior year. That translates to additional wealth of about $50 billion. That was nice. That supported consumers in the first quarter of the year, but that's gone. And so now we know that we're dealing with higher energy prices. What does that mean for consumer confidence and ultimately their willingness to continue spending and helping to grow this economy? So plenty for us to watch in the coming days. I'll leave it there for right now. If you have any questions, please don't hesitate to reach out to your advisor. We'll plan on checking back in a couple of weeks. I'm sure we'll have plenty to discuss then, but until then, please enjoy the Memorial Day holiday, and I'll see you soon.